So, what happens when the world's most important energy artery just suddenly gets clamped shut? Well, we're about to run a crisis scenario where that exact thing happens, triggering a massive global shockwave that could send oil prices soaring past $150 a barrel and just create absolute chaos in the financial markets. Let's dig into the playbook for a cataclysm like this. This right here, this quote nails the real danger. Because while everyone's eyes are glued to the price at the pump, the real crisis, the one happening behind the scenes, is a global liquidity freeze. It's that moment when the entire machinery of global finance just seizes up, not just from a lack of oil, but from a complete collapse of trust and a massive explosion of risk. All right, here's our roadmap for today. First, we'll look at the choke point itself. Then we'll dive into a simulated crisis called Operation Epic Fury. After that, we're going to decode the market's panic signals, expose a really nasty hidden trap for investors, and finally trace that global shockwave as it spreads across the entire planet. Okay, let's start with the absolute fundamentals. The Strait of Hormuz. It isn't just some random waterway. It is the absolute linchpin of the global energy supply. It's this tiny, narrow passage that connects the Persian Gulf to the open ocean, with Iran on one side and Oman on the other. And get this, at its narrowest point, it's only about 21 miles wide. And through this incredibly fragile artery flows a truly staggering amount of the world's energy. This single number really says it all. 20%. 1/5 of all the oil shipped by sea every single day, we're talking 21 million barrels, has to squeeze through this one little choke point. And with the vast majority of that, about 84%, heading to Asia to power the economies of China, India, Japan, and South Korea, a closure here isn't a regional problem. Oh no, it's an immediate, direct threat to the factories that power the entire global economy. But here's the thing, the crisis goes way beyond just oil. The strait is also the main pipeline for about 20% of the world's liquefied natural gas, LNG, which is crucial for heating and electricity, especially in places like Europe and Asia. Then you've got urea fertilizer. A third of the world's supply goes through here. So disruption directly threatens global food security. And if that's not enough, almost half the world's sulfur, which is essential for everything from car batteries to semiconductors, is suddenly at risk. A blockade isn't just an energy crisis. It's a food and a technology crisis all wrapped into one. Okay, so with the stakes this high, let's see just how quickly it can all fall apart. We're going to dive into a super detailed case study from our source material, the 2026 Iran war scenario. Now, this isn't a prediction, okay? It's a strategic analysis of how a regional conflict can escalate and fast into a full-blown global catastrophe. Just look at how fast this thing spirals. On February 28th, the scenario kicks off with an air campaign called Operation Epic Fury. Only 4 days later, on March 4th, Iran hits back, declaring the strait completely closed. The market's reaction? Immediate and violent. By March 8th, just a few days later, Brent crude, that's the global oil benchmark, has already surged to $126 a barrel. And by April, the whole situation devolves into what's called a double blockade, with the US trying to clear mines while Iran is actively attacking shipping. In less than 6 weeks, the world's energy artery has turned into a war zone. And this chart just visualizes that pure panic. We start at a pretty normal pre-crisis price, say $70 a barrel. In just over a week, it nearly doubles to $126. And you've got to remember, this isn't even the worst-case scenario. Analysts project that a sustained blockade could easily push prices well past $150, with some models even suggesting a peak near $250. I mean, those are price levels that absolutely trigger a severe global recession, no question. So we've seen the what. Let's talk about the how. How do financial markets actually process this kind of panic? Because it's not just about the price going up. There's a much more subtle, much more sophisticated signal that traders are watching like a hawk. A signal that tells them exactly how desperate the world is for physical supply, like right now. Yeah, think about this for a second. In normal times, right, the price for oil in the future is usually a little higher than today's price. That makes sense. It accounts for storage costs, inflation, stuff like that. But in a crisis, that logic gets thrown completely out the window. The world doesn't care about oil in 2030. It needs oil today to keep the lights on and the trucks running. And this desperation creates a very specific and very revealing market structure. And that structure has a name. It's called backwardation. Honestly, you can just think of it as the financial market's screaming fire alarm. When the spot price, that's the price for delivery right now, is way, way higher than the futures price, it is screaming at you that there is a severe physical shortage. Companies are so desperate for barrels to refine into gasoline today that they are willing to pay an enormous premium even though they know the long-term price will probably be much lower. This slide just perfectly captures the two extremes. On the left, you've got our 2026 crisis. The spot price is $126, but the market is betting the crisis will eventually end, so the price for delivery way out in 2030 is only $65. That's backwardation on steroids. Then on the right, you have the total opposite from 2020, a massive demand shock from the pandemic. There was so much oil and literally nowhere to put it that the spot price famously went negative. Yeah, they would pay you $37 to take a barrel of oil, but the future price was still positive. That's a state called contango, the market signal for a glut. Here's a really simple way to think about it from the source material. A war or a blockade is a sudden short-term disruption, and it leads to this frantic scramble for any barrels that are available right now. But the market assumes that over the long haul, new sources will come online, the crisis will get resolved. Backwardation, well, that's just the price of that short-term panic. So we've seen the macro crises, we've seen the market signals. Now let's zoom right in on a really common and really costly mistake that a lot of investors make when they see prices spiking. They rush out to buy these popular oil ETFs, but they often walk straight into a hidden financial trap. It's such a frustrating paradox, right? You see oil on the news, it's at $120 a barrel. You go buy an oil fund, and even if the price stays that high, you check your statement a month later and you've actually lost money. How is that even possible? Well, the answer is buried in the really complex plumbing of how these funds actually work. The answer lies in this technical-sounding term, roll yield decay. I know, it sounds complicated, but just think of it like this. It's a constant, slow leak in your investment bucket, and it's caused by the way these funds have to operate in the futures market. Okay, let's break this down nice and simple. Your oil ETF, it doesn't actually own physical barrels of oil. It owns futures contracts. So let's say it holds the July contract. Before the end of July, it has to sell that contract and buy the August contract to stay invested. Now, in a normal market, which is usually in that state we called contango, the August contract is a little more expensive than the July one. So this forces the fund to systematically sell low and buy high over and over, month after month. And that process creates this small but totally relentless financial leak in your investment. And we are not talking about a small leak here. The source material shows that during normal times, this roll decay can eat away at an ETF's value by 8 to 13% every month. That is a massive headwind to overcome. It basically means the price of oil has to rise by a huge amount just for you to break even. It's the brutal truth of the matter that catches so many investors completely by surprise. Okay, time to zoom all the way back out. We've looked at the geopolitics, we looked at the market mechanics, and we've seen the traps for investors. Now let's talk about the real-world consequences. What actually happens to the global economy when this fragile artery finally closes and that shockwave starts to spread? Well, the initial closure triggers this catastrophic domino effect. The energy spike is really just the first domino. That immediately causes an insurance panic that brings all commercial shipping to a grinding halt. Together, those two fuel a massive surge in inflation, which then creates widespread supply chain chaos as goods just stop moving. And the final domino to fall is the most devastating of all, global food insecurity. And the shutdown is almost instantaneous. According to the data in our scenario, the second Iran declares the strait closed, maritime traffic plummets by 90%. Ships don't stick around to see what happens. They divert, they anchor, or they just suspend their transit completely to avoid being attacked. The world's busiest energy highway becomes a ghost town overnight. Now, this is how the strait becomes effectively closed, even if there isn't a physical blockade. The marine insurance companies, they react instantly. War risk premiums, which are normally a tiny, tiny fraction of a ship's value, skyrocket to 5% per trip. For a supertanker that's worth hundreds of millions of dollars, that is an economically impossible cost to pay. No company is going to pay it. So even without a single shot being fired, commerce just grinds to a halt. And here is how this big geopolitical event lands directly in your wallet. The scenario modeling suggests a sustained blockade would add nearly 1.5 percentage points to U.S. inflation. This creates an absolute nightmare for the Federal Reserve, forcing them to choose between hiking interest rates to fight inflation or cutting them to save an economy that is now tipping into a recession. It is the classic stagflation trap, and there are no good options. And all of this brings us to our final and I think most provocative question. For decades, the entire world has operated on the assumption that, despite all the regional tensions, the flow of energy from the Gulf would be protected at all costs. A crisis like the one we've just walked through, it completely shatters that assumption. It forces a permanent repricing of risk and could accelerate a global shift away from Middle Eastern energy altogether. This could very well be the event that ends the narrative of the Gulf as a stable, safe hub for global capital. And that is a structural shift with consequences that would last for decades to come.